Hey everybody, good to be here. Back with you this week for long options. This is following up last week's session. Last week's session, we talked about trend trading long options. This week, we're going to talk about swing trading. In fact, if you missed last week's session and you're interested, I just put a link in the chat there for you if you're watching live. Otherwise, you can just hit that playlist up on YouTube. Trader Talks channel, Schwab. And in this class last week, was, I don't know what the date was. The date was the 7th last week. We did trend trading. This week we're doing swing trading. We're going to do a similar type thing. We're going to do a sample trading plan. That's what it is. It's a sample. It's not a recommendation of how exactly you should trade, but I think having some kind of starting point is a good place to go. Now I'm joined alongside by my friend and colleague, Connie Hill, who's in the chat helping me out. You can follow either of us on X at Brentmore CS, at Connie Hill CS. We post additional content there. And you know what? You don't have to, you can get on X if you want, and you don't have to, you can kind of like follow the people you want to follow, and you don't have to post if you want to check that out. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not a recommendation of any security strategy or chart type. Schwab does not recommend the use of technical analysis as sole means of investment research. Paper money application, which we'll be using today, we'll be using the Thinkorswim desktop platform. It's provided for educational purposes only. I won't always factor in commissions in what I'm doing, but just realize though those are a real thing that you need to consider. All investing involves risk, including risk of loss. There's no guarantee of an execution on a stop order that it will be at or near the stop price. And the paper money application will not assign a short option position early. That's paper money. In real life, it's very different. You may get short options assigned early. Here, we're dealing with long options, though. Past performance in any security strategy does not guarantee future results or success. Let's head on over to that Thinkorswim platform there. And I want to do kind of similar to what I did last week, in that what I want to do is I want to go through kind of a sample trading plan, discuss some rules, and then look at examples. That's the plan. And so if you're brand new to this, or you've been around, doesn't matter. I want to help you out either way on that. But one thing I want to do is I want to start out with just kind of this notion of swing trade versus trend trade. In fact, let me scroll this down here for a sec, because I've talked already, I've used those terms, and some of you may not know what those terms even what I'm referring to. If you think of a stock, and I'm going to stick with kind of a stock that's been trending up, and it doesn't always look super pretty, but here's a stock that's trending up. Trend traders will often get in a stock, and they know if it's going up and it's trending up, you're going to have these pullbacks along the way. And so they're willing to sit in through those pullbacks. And if they pull back, great, that's to be expected. As long as that general trend is continuing up, they're willing to stick with that trade. That's a trend trade. That's what we did last week. So I don't want to belabor that point, because I covered a whole session on that last week. Swing traders often try and get in for a certain period of time, and then they get out when they hit a target price, okay? And so we can talk about how to find that target price, what we're looking for on that, and we'll give examples on that. But swing traders try and cut out these pullbacks along the way, even if it's trending up. And so that's the main difference when I'm talking about a swing trade and a trend trade. Now, they can occur different time frames. Typically, I'm going to be using daily charts. In other words, each candlestick or bar represents a day's worth of time. But as you can see on this SPX chart here, each one of these candles represents 1 day's worth of time. This is a 9-month chart. Doesn't matter what time frame you're using. I don't care. You can use a 6 months, you can use a year, use longer. I'm trying to balance between making it easy enough to see the individual candles, but also give you some perspective so you can see things like where past support and resistance levels are. Because when we're doing technical analysis, whether we're doing swing trades or trend trades, we're still going to look at a lot of the same stuff. We're going to look at the trend. That's kind of like number one. We're going to look at support and resistance. Okay, those are going to be levels. And then we may look for, when we're talking about this, we may look for like a bounce or a breakout as a means to get in. Okay, I talked about those last week, but they're important for this week too. So we'll look at examples with those. Okay, so that's the basic technical analysis stuff here that we're going to be doing. And before I get into the actual rules, let's just take a quick look at the market. This is the S&P 500, folks. I have a 10 and 30-day moving average here. If you like this script, if you want this script, it's posted on my X page. This is just the cloud 10-day EMA, 30-day SMA script. When it's showing green, it means a 10-day is above the 30-day. Generally, we're going to consider that to be more of a bullish type indication on the market. Doesn't mean things can't change. Look, it was bullish, right? It was given this kind of bullish, more greenish signal back here. That changed. Now we're in this reddish zone. And you know what else? As you scroll through stocks, and I've scrolled through a lot of stocks. I've been going through the S&P 100. Most stocks are kind of going down right now. And that's probably reflected in the S&P 500. In fact, even more so perhaps, I would expect, let me just take a quick look. Let's look at that SPX EW, the equal weight SPX EW, and see what we got. You see, that's even down a little bit more. And what that's saying is, instead of just letting those few stocks that really dominate the market cap of the S&P 500, we're going to kind of spread it out and look at each of them equally. And you can see, if anything, it's been more bearish there. So in any case, let's move on and actually look at a trading plan here. Hopefully this sample plan will be of benefit to you here on this. Okay, so in terms of watch list, there's going to be some overlap, no doubt, between this plan and the plan we did last week. I still want liquid stocks with potentially liquid options. Okay, primarily when I'm looking for liquid options, I'm going to look at that bid-ask spread. Now you can look at open interest, and hopefully you have a few hundred maybe contracts of open interest when you're looking at those. I would not, however, suggest just looking at the option volume. And one reason is that option volume resets to zero every day. It's just today's volume. So if you're looking early on in the day, that may not be the best indication of it. So you can use open interest, you can use that bid-ask spread to try and help you out. And so I'm going to be using things like, for example, the S&P 100 as a potential watch list. Okay, or you can create your own list of just liquid options. I'm not, especially this week, I'm not using fundamentals. Now, last week I kind of left it open a little bit. Some traders like fundamentals. In other words, if you don't know what fundamentals are just like the financial attributes of the stock, as opposed to the technical analysis, which is what the chart is doing, what the stock price is doing. Here, because we're looking at shorter term time frames, we're not going to be in this very long, probably. The general feeling, I think, amongst most traders is, over the shorter term, the technical analysis becomes more important. Over the longer term, the fundamental analysis may kind of take more importance. But here we're looking shorter term, so I'm not using fundamentals in this case. Could you? You could. It's, you know, this is just kind of our sample plan here on this trade. I want to welcome everybody for coming in. We see some familiar names there. That's awesome. That's great. My buy rules. Number one, now this plan is going to be for either long calls or long puts. So if I'm doing long calls, what I like to see is typically trend up. If I'm looking at long puts, generally what I'd like to see is trend down. Okay. So that's the first step. And that's typically the most important thing we're looking at is that trend. But it's not just the trend. We're also going to look at support and resistance. We're going to look at momentum. If you want help with that trend, typically we're looking for higher highs, higher lows for an uptrend, lower highs, lower lows for a downtrend. You can use that moving average crossover, the two moving averages I showed you earlier, as a possibility there. And then for an entry, we're going to be looking for a bounce or a breakout. Okay? And we'll look at examples of that here coming up. So those are our first rules. Those are the buy rules. Now the buy rules, great, but that's not everything, obviously. We're going to need to look beyond just what the buy rules are. What option trades are we, what option specs are we going to do? These are shorter term options. We're going to try and anticipate how long this trade is going to go. So I'm going to take the expect, in terms of for expiration date, what expiration date should I use? I'm going to take the expected move. So if I think that move is going to take 1 week's worth of time, that's my expected move. And then I'm going to add on another, about 20 days maybe. 20 days. So if I think that move is going to take 3 weeks worth of time, then I'd probably go out, over a month and a half then in that case, or something like that. So that's my expiration date I'm going to look to choose here on these swing trades. Notice this is different than those trend trades, which may go on potentially for a longer period of time. I'm going to go, in terms of picking what strike price, I'm going to go 1 strike in the money. Now, if I want to be more aggressive, I'll go 1 strike out of the money. If I want to go more conservative, I may go a little bit more in the money. But that's just kind of the general rule that we're going to look at there, okay? Okay, and let's go and let's see what else. And this goes back to the liquidity thing. Bid, ask spread. I'm going to say that's supposed to be less than 10% width, okay, between the bid price and the ask price. So if my ask price is $3, 10% of $3 is 30 cents, okay? I wouldn't want my bid price to be any less than 270 on that. Hopefully tighter. 5% would be better, okay? Question from Probability Trader. Brent, sometimes a trend shows up, but it can also be a lower high. How can we avoid false trend like this? Okay, so the question, let me just kind of generalize the question, and that is, trends can be tough sometimes, because when we're looking at trends and we say, uptrend is higher highs and higher lows, it's not always perfect. And so, and trends change. So you need to be aware of the changes, but also that may be one sense of where you can kind of use a rule like this and say, hey, if I have my crossover, and I have a 10-30 day, 10 EMA, 30 SMA, you don't have to do that. You can use simple moving averages. You can use different time frames. But you can say, look, sometimes I get a lower high along the way. Let's kind of take this. Here we had a high. Here we had about an equal high. This could have been a little bit lower for all we know. Is this still an uptrending if we get a lower high, or is it maybe a lower low? You could say, as long as I'm green on this, I'm still going to call that an uptrend, even if you have a little bit of a blip in it. But once it crosses, then we're going to say, nah, that trend is no longer the trend anymore. But when we're trying to distinguish between, if we're just simply not even using moving averages and looking for higher highs and higher lows, so let's say we have a high, and we're trying to look at when is that going to cross over. Say we have higher highs and higher lows, okay? Low, higher low. And then we get a lower high. We're not immediately probably going to call that a downward trend, but once we get a lower low on top of that, then that's showing a change in trend, okay? That is showing a change in trend at that point, Okay, so let's get back to our plan here. But it brings up, I wanted to go to that because that's an important question. And the reality is, you never know for sure. You know, how can you prevent against the trend changing on you or a false breakout or things like that? You can't. Those things do happen at times. The important thing is that you try and be consistent in what you do. Have a repeatable plan. Okay, and I'm going to say best if in IV is low. Okay, this is something that applies to trend trades, swing trades. If implied volatility is low, then you know what that means? It means options are cheaper. That's great. That's what we want. But ideally, what happens is after you get into a long option, hopefully that implied volatility goes up and the options become more expensive. But keep in mind this, when we're talking about options, implied volatility is just one little piece of the puzzle. The price of an option mostly depends on, well, we'll say it has like 3 main components, and there's even more. You could even talk about interest rates, okay? I'm not going to talk about interest rates here right now on that, but it's becoming more of a factor. Interest rates move more. The stock price, P, stock price moves that. T, time value, theta affects it. Implied volatility affects that. So if the stock is moving one direction strongly, it may kind of overwhelm any differences, changes in implied volatility there. So implied volatility is certainly not the most important thing. And if everything else looks good, but implied volatility isn't perfect, I don't think that's going to keep most people out of the trade there. Okay, but ideally, yes. If implied volatility is low, that's great. If implied volatility is low and going up, even better. Okay. All right. And there is a survey link in the chat, folks. We always appreciate your feedback if you want to do this. Let's move on with our plan, and then we'll get to some sample trades here as we look at this. These are swing trades, and I think I've said everything I want to do about those option specs. Risk management, my rules are going to be very similar to what I did on the trend trade. I'm going to use for our purposes a 1% risk. 1% risk. I'm assuming we have a $100,000 portfolio in there. Okay. Let's go and here's one. This is different than last week. Look for risk reward of maybe 2 to 1. I'm going to say at least 1.5 to 1. What do I mean by that? And why didn't we talk about this last week? When we talk about reward to risk ratio or risk to reward ratio, I actually inverted those. In fact, I should probably correct that, folks, because I don't want to mess anybody up when I say 2 to 1. Reward to risk. Okay, risk. So if you have a defined reward, which we can define by a target price, if we're doing a swing trade and we're saying, well, we're going to get in here, it looks like it's bouncing there. We're going to get in there. And I think it's my target. I think it's going to move up to here. Then I have this target area that I can shoot. And then what I can say is that's my potential reward from my entry point to my target price. Okay, that's my reward. That's my potential reward. And then maybe I set a stop or something beneath it. Okay, and we're going to say, well, the difference between my entry price and my stop, that's my risk. Okay? And so what I can do is I can say, that's going to be my risk to reward ratio, the proportion of how big the reward is compared to the risk. Now, stops aren't guaranteed. You know, I say that a lot. You guys have heard me say that a million times. Stops aren't guaranteed, but that's how we're going to, for this reward to risk ratio, that's how we're going to decide on that stop there. So I'm saying 2 to 1. Now, why didn't I talk about it last week? Because if we're doing a trend trade, not these swing trades we're talking about this week, if we're doing a trend trade, our potential reward is undefined because we're just planning on staying this as long as the stock keeps going up and up and up. So that's why I'm going to say 2 to 1, or at least 1.5 to 1 would be a good reward to risk ratio there. All right. I'm hoping that is making sense, everybody. That's risk management. And then finally, one more section, and then we'll get to trades, and that is exit rules. I'm going to put in I'm going to say stop loss 1% below bounce low. Let's say we're getting on a bounce and we're going to go to the low price of that bounce. We're going to go 1% below that. And that'd be based on the stock price. Or stop loss 1% below breakout level. If we have a defined breakout level we're breaking above, then we're going to go just below that. And keep in mind, if we're doing, say, a bearish trade, a long put, then instead of below, we'd say above. Above high. Okay, and we say above breakout. All right, let me just go, and we've got a few more here. Those are based on the stock price. If I go based on the option price, I'm going to say stop loss 50% of option price. All right, now I mentioned earlier we'll exit on a support break. The answer is this is kind of a moot point, because if we have our stop loss there, it's going to get us out anyway. So that may be a little bit redundant anyway to say that, but I put it down on my notes. Okay, exit at target. So that would be a good situation if the stock went up and hit our target price. And the final one is, what if the stock is, actually, before I do that, I'll add one more. Exit, if we're basing it not on the stock price but on the option price, exit at 200% of entry price. Okay. And then finally, last one is, what if it's not, we get in the trade, it's not going against us, so we're not getting stopped out, but the stock just isn't going anywhere. Well, we're going to exit inside of 10 days until expiration. Okay, so those are the rules. Those are our rules we're going to be looking for here. And if you're watching, you can do a screenshot if you wanted to. That's your choice. But again, they are sample rules of those. Or if you're watching on recording, you can always pause the recording as we do that. All right, let's look at some potential example trades here. So I'm going to move this out of the way, and I want to go over here, and let's look at both bullish and bearish trades. All right, there are probably more bearish here, but I'll do a mix. I'll do a mix of them here. So let's do this. One thing that we are going to have a challenge with, though, is earnings. So, for example, I could see this as a potentially a bounce up. The stock came down. Now, here we have a downtrend, so this would be a little bit counter trend, which we generally don't want to do. But just this is an example of, if you have earnings coming up, that is going to discourage a lot of traders from doing that trade. You don't have to. You could get in on earnings, but if you just look at, say, the S&P 100 over here, everything that has this blue and red dot on it has earnings coming up. Just look at the percentage of stocks that have those blue and red dots on them right now. So just a ton of companies are coming out with earnings right now. So that's going to affect things. Now let's look at some others here. Let's look at Target. Okay, so here's Target. And what's our trend? Well, we've had higher highs and higher lows. And to our previous point here, of the trend being, sometimes a little awkward. Look, we had a high and then we kind of had a little bit of a lower high. That was a little bit iffy, but generally we've been having higher highs, higher lows. Our 10 is above our 30, so we're going to call that looking reasonable on that. And let's look at, say, a long call swing trade on this. Now, this is not giving me a bounce today, but I can put in a contingent order here because my trend is up. Remember, my conditions for this is I want the trend to be up, and then I want it to be bouncing. Now, I may have a support level, which I like to identify. Here's my support level. Looks like we may be here, but there's no sign of it bouncing yet. So what we could say is, look, this stock right now is at 137.5, but if this starts to bounce up to, say, 138, let's buy a call option on this. All right, so let's do a call option on this. Notice there's no earnings on this coming up in the near future. We had earnings mid-November, which means we'll probably have earnings December, January, February, mid-February, but that gives us enough time. How many days of a move are we anticipating? Well, I don't know, but let's look at this. Let's look at how long the most recent move up went. We went from here, right in here, to here. So what's that? Maybe 3 weeks, something like that. You can go to the one before that. What was that move? From there to there? Well, maybe 3 weeks. We don't have to be precise on this, but I'm going to call that about a 3-week move. So in terms of my expiration date, remember what we said on the expiration date? We said expected move plus 20 days. Well, 3 weeks plus about, we'll say 3 more weeks, about 6 weeks or so. We don't need to be precise on this. About 6 weeks till expiration is where I'm going to go. Now, question, how long should the trend be up? As long as for it to be a defined uptrend would be my take. In other words, we need a series of higher highs and higher lows, or if you want to use this, I want to see that crossover have occurred. Here, I had a low down. Let me change my color. Let me erase this for a sec, okay? I had a low, okay? And then this was kind of a higher low, and this one was, well, we'll call it equal to higher. But now we've gone up, and now we're hopefully establishing a higher low. Here we have a high, high, higher high, probably, but equal high, higher high. So if we go back in time and we were looking at this back here, do we have an uptrend? Well, this was kind of iffy here. So I want a series, not one higher high, not one higher high, not one higher low, a series of higher highs and higher lows. So is it going to be 6 months? No, typically no, it's not going to be 6 months. Is it going to be 3 months? Probably not 3 months. Are you going to get a trend after a week? Not using daily data, you're not. Maybe if you go intraday, you could see that, but that's not the time frame we're using. So typically, we're probably going to be looking in the 3-4 week range, something like that, to actually establish that trend. So that's a great question, AJ. I appreciate that question there. Okay, so we established our time frame on this. Target is a relatively, well-traded stock, so it gives me hope for the liquidity there. Where's my target price going to be? Well, there's different approaches to making target prices on these. One is I can go to a past potential resistance. I could say, oh, look, if I go up here, that's a potential target price. This was a support bounce. Bounce, 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 bounce. Okay, so that's one way of doing it. Another way of doing this is to kind of measure the past moves. You can look at a couple moves ago, see how it went. Look at the past move. Let me look at the past move here. I'm going to just measure it. I'm going to go from my low to my high. I'm going to right click on that. I'm going to duplicate that. And I'm just going to move this right to where my new bounce is, presumably my new bounce. And that gives me a slightly higher target price on that. Okay. And so, so that gives me like a 151 target. This would be a more conservative target if I want. This will give me a more ambitious target if I want, up to 151. So you can choose if you want on that. Where's my stop going to be? Well, I'm going to try and put a stop in if we go 1%. Remember those rules I said? The rules for this plan, doesn't mean the rules you need to use, but the rules for this plan were stop loss 1% the bounce low. Well, I'm assuming, remember, we're not going to get in right now. We're going to wait for that bounce. But I'm going to assume we're bouncing off, this is the low. I'm going to assume this is going to be the bounce low, which is 137.42 is the current price. Our low is, what's our low for today? Our low for today is 137, basically 137. I'm going to go 1% that below that. 137. I'm going to take my calculator and multiply it by 0.99. That's a 135.60 stop. I have a 151 target. My entry price, I said, look, we could look for it to bounce up to 138. We can look for it to bounce up halfway above the previous candle. You can look for a close above the high of the low day. We could say, I only want this to go if we break above today's high. Well, what's today's high? Today's high was 140.75. 140.75. Let's just do a little math here, folks, real quick, okay? Just for our reward to risk ratio that I talked about. If we get in at 140.75 and my target is at 151 and my stop, I'm going to assume we're going to get out of my stop, is at 135.60. Okay. What's the distance between my entry price and my target price? It's about $10, just a little bit over $10. I'm just going to write 10 down there. What's the distance between my entry price and my stop price? About $5. That gives me about that 2-to-1 reward to risk ratio. Now keep in mind, just because that's a reward to risk ratio doesn't mean we're going to be getting out exactly when we want to get out. And it also doesn't mean that the option pricing is going to be the exact same as what the stock pricing is. But this is just kind of a rough way of deciding, is this reasonable in terms of what we're doing here on that, okay? Now, if you have questions, feel free to type those questions in the chat on this trade. I'm going to do a long call swing trade on this. Let's just kind of go up here and let me look at this. And I'm going to go, and I just want to review a few things. Trend we said was up. Looks like we're banking on a bounce. We're putting a contingent order because that really hasn't bounced yet. Expected move plus 20 days. So we said we were going to go out about 6 weeks on that. Strike, we haven't chosen that yet, but we'll go one strike in the money. We're going to double check that bid-ask spread. And if you want, you can look at that implied volatility. Let me just do this. Let me go implied volatility. Here's our implied volatility. Implied volatility is actually pretty low on this right now, okay? Hopefully this goes up, but the reality is if this stock is going up pretty well, it's probably unlikely that implied volatility is going to go up a lot. So that's certainly not going to make or break the trade here on this. Let's go to trade. I'm going to go out about 6 weeks. How long 6 weeks? We'll go 38 days. How about? Let's go out 38 days. I'm going to go one strike in the money. That's going to be this one right here. My bid-ask spread is about 15 cents on a 620 option, so that's fine. I'm going to right-click on this, and I'm going to buy custom, and I'm just going to put with stop here. Now, we're actually going to have a target price on there as well, and we're not going to use a true stop, but let's just kind of look at this over here. Here's my entry on this, but we said we don't want to enter right now. We want to enter if the stock goes to 140.75 or higher. I'm going to change my order to a market order. I'm going to change day to GTC. I'm going to go over to my little gear. By the way, it gives me a little error message. Okay, it gives me a little error message. I'm going to click on this. I'm going to go over here and I'm going to click here, target, marks, greater than or equal to, and we said 140.75. I don't know why that's scrunched down so much. Let me try this. Well, it doesn't want to show you that, but let me just type in 140.75, 14, oh, come on, 140.75, okay? And, yeah, there we go. Now you can see it. Say that. That's my entry on this, okay? Now, I'm going to do the same thing. I'm going to change this to market. I'm going to make this good till canceled. Now we have two conditions on this exit. One, I'm going to click on my gear. I'm going to say if target marks less than or equal to my stop, which was 135.60. 135.60. Or mark is greater than or equal to, this is going to be my target price. My target price was 151. We're going to get out on that. I'm just going to click on confirm and send. And I just want to review this. So I'm going to buy it if target marks 140.75 or more. We're going to sell if it marks at or below 135.60 or at or above 151. Okay. So if you wanted to get a screenshot of that, you can. And let me just edit this. This, you can't see all the details because you got to click on the gear to see those details. I'm going to confirm and send. And this is going to be a long single option. Send that. There we go. So did that fill? No, that didn't fill because we're waiting for it to bounce here. Now I want to show you a bearish example. But before I do that, let me just mention this. I have a long single options class. Okay. Long singles options group. Last week we did a trade on Oracle. It's doing pretty well, actually. I plan on managing these in the managing options portfolio class, which occurs tomorrow. Lo and behold, I'm out tomorrow, but Connie is going to be in tomorrow. So this trade is actually doing pretty well. We may consider moving that stop up on Oracle. I'm going to let Connie look at that tomorrow there. So make sure you check out that managing options portfolio class tomorrow, because we got some other trades that may need some managing too here. The trade we went in last week, we did an order on American Express last week. It never filled. We never got in because it didn't meet the conditions. Just like this target trade may not meet the conditions. That's okay if it doesn't. Then we're just aren't going to do that trade. Now let's look at something more bearish here. Actually, before I go to the bearish trade, and I'm getting a little lower on time, so I need to hurry here. Let me just mention a few other type bullish potential trades. Look at, say, 3M. Well, is this bouncing up? Yeah, this is like a potential breakout right here on 3M. One challenge we have on this, though, look, earnings, again, coming up and making it difficult on us there. Let's look at Walmart, okay? Walmart, again, I have kind of a resistance level. I have a support level. Let me just zoom in here a little bit. If we get in and use this as a potential target price and this is a stop, that reward risk ratio would probably make sense. It would probably work out there, okay, in that case. Doesn't mean the trade's going to work out, but the setup, the reward to risk ratio may work out, okay? Let's go and let's look at potential bearish trades here. Let's look at another, this one, Caterpillar. We've got a trend Could be looking for a bounce here. Again, we'd probably do a contingent entry on that trade. Let's look at CHTR. Again, downward trend, looking for a bounce. We have a nice bullish day. It's interesting. Today's kind of this contrary day. The bullish trades are all down today, and the bearish trades seem to be up. We could use a contingent entry on that. In other words, wait, but put the entry only if we get that bounce down if we want. Okay, let's look at one more. And this will be our final trade today. I don't know what just happened here. Somehow I got a phantom click. BIIB. Okay. Didn't stick. BIIB. Okay, here we go. Let me zoom in. We have, let me just do plain chart here. We've got a downtrend, lower highs, lower lows. We've got a bounce off of a potential support level, resistance level down. That is a potential entry. What's our target price going to be? Well, here's what I'm going to do. I'm going to say, I'm going to look from the same type thing that we did here last time. I'm going to look how big the previous move was. That was a $20 move down. It's an expensive, relatively expensive stock, $20 move down. And so I'm going to assume a similar type move down from our high. So from 155 down to about 135 is going to be my target. So I'm going to say 135 is my target price. Entry is going to be right where we're at right now, 144.78, almost 145. Okay. Stop, I'm going to put it just above, 1% above that 150 level. 1% above 150 is going to be 150, 150. 150, 150 is going to be my stop. Okay. So 150, 150. I'm calling it a stop. Remember, it doesn't guarantee where we're going to get out on that. Let's consider this from a reward to risk ratio. 145 entry. 135 target. Reward to risk ratio, about 10 there. A little bit more than 5 there, about 6.5. We're better than that 1.5 to 1, not quite 2 to 1 on that, but I'm going to call that good enough for us. And I want to do the trade. Now, so what I'm going to do is I'm going to go to BIIB. Now, one thing I know about BIIB is liquidity is iffy on BIIB. And so what I'm going to do is there's a huge difference, and I'm not going to do this whole trade. I'm going to do the end of this trade right after we're done with this class because I'm not going to have time. But let me mention this. If I'm doing a long put on this, look at the bid-ask spread on these weekly options versus, this is $1.50 on that contract for the 145 contract. Here, it's only 40 cents. On BIIB and others, double check the bid-ask spread, and that is key. I'm going to do a long put swing trade on BIIB. I'm going to enter it the exact same way I did the call trade. I'm going to put it in, and we'll look at that next week on that, okay? So I'm out of time, though, is my only problem here. So I'm not going to do that right now, but I'm going to right-click on it. I'm going to buy custom with the stop, and then what I'm going to do is I'm going to go to Market, GTC, and I'm going to click on the gears and put those in right there, okay? These are long put trades here. So we talked about the rules. We gave you a sample trading plan here on this for long calls, long puts, swing trades, and we gave you an example of a long call, which we entered, gave you a few other potential examples. We did an example, enter. We did some potential long puts and one that I'm about to finish entering here as soon as we're done there. Thank you all for joining me all today. Appreciate that. Coming up next, we have Getting Started with Technical Analysis. Connie, thanks for helping me out today. And I wish you all a wonderful, blessed Tuesday. Bye-bye, everybody.